Hi everyone, this is an online accountancy course developed for class 12 students of Bhutan. And today I'm going to present and discuss on the accounting for investment in bonds. Before I take you through the accounting for investment in bonds, let's see some of the bonds issued by companies of Bhutan as well as the Royal Government of Bhutan in our stock exchange, that's Royal Security Exchange of Bhutan. Under bond, if you see, these are the trading securities. There are numerous bonds issued by the companies as well as Royal Government of Bhutan. You will see the maturity period, rates, amount, effective date, maturity date, and so on. For the part of issuing company side, it was already covered in our last lesson. So today I'm going to discuss only on accounting for investment in bonds from the perspective of investing companies. In this lesson, let's state the purposes of debt finance for better understanding. Identify some common debt instrument issued in Bhutan. Explain negotiable instruments with an example. Pass general entries to record the purchases of bonds and present it in a financial statement. And finally, let's compute the interest receivable on bonds. What are some of the purposes of debt finance? It is very rare to see business entities using their own funds for their business. Many business entities continuously depend on borrowed funds either from banks or other money lenders. If a business has surplus cash, it might decide to invest in corporate bonds, commercial papers, and so on, including the fixed term deposits with commercial banks. Business entities with appropriate debt equity ratios are considered good business entities. The government also issues bonds to the public to regulate money supply in the economy. What are some of the different types of debt instruments issued by the government as well as companies of Bhutan? Number one, you will see treasury bills. The treasury bills are issued by the only government to regulate the short-term money supply in the economy or to raise short-term finances for the government. Bonds are issued by the companies to raise long-term finances. And at the same time, government also issue bonds to regulate money supply in the economy. In Bhutan, if you look at the Companies Act, instead of bond, you will find still the term as debentures. However, you must understand that debentures are insecure financial instrument and hardly you will find any debentures issued by the companies. Commercial papers are issued by the companies to raise short-term finance, basically to meet their short-term working capital. Loans are issued by any financial institution in the country to raise long-term finance. But you must understand that although it is a debt financial instrument, it is not negotiable instrument. The borrowers will have to abide by the conditions imposed by the lenders. Discounting bills of exchange is one of the oldest means of raising finance, where if the company has sold goods on credit, the bills received for credit will be discounted with the banks and get finance from the bank till the duration of the credit terms. These are some of the common debt instruments you will find in Bhutan. The definition related to financial instrument has been covered in last lesson. So today let's take an example and try to understand what is a financial instrument and basically what are the terms of financial instrument. Let's say a company issued bonds on Royal Security Exchange Limited to raise capital of 30 million. These bonds are issued for a period of 10 years. Can you analyze this contract and see whether there is a financial instrument if the investors have subscribed to these bonds? We have studied earlier that the fundamental conditions of financial instrument is a contract. The contract can be either written, verbal, or implied. So here, when the investing companies or investing individuals purchase bonds or shares from the companies, they do not come in direct contact with the issuing companies, so therefore the contracts are mostly implied. Let's look at whether there's a financial instrument and what the conditions of the contract. There is obviously a contract between the bond issuing company and the investors with those subscribing to the bonds. What are the conditions of the contract? Here the bonds are financial instrument, and the implied terms of the contract are: for the issuing company, when they issue bonds, they are going to receive a fixed amount of cash from the investors, and another condition for them is to repay the investors with the principal amount of the bond along with the interest as agreed in the contract during the time of issue. The issuing company recognizes the issue of bonds as financial liability. From the perspective of investing company, what are the terms of implied contract? They are going to receive annual coupon interest and the principal amount on the redemptions of the bonds that is after the maturity period. So for investing company, the bond purchase, investment or investment in bonds will be recognized as financial asset. Let's take a hypothetical question to explain further on investment of bonds. Let's say a company purchases bonds of company B. So company A is investing in the bonds of company B, which was issued at nominal value of 1,000 at the beginning of 2020 for Newton 1 million. Transaction costs in relation to purchase of bond was 5,000. Company B is going to pay annual coupon of 8%. The bonds matures in 3 years. The effective interest rate is 10%. How do company A records in their books show interest income for 3 years? Before we find solutions for the problem, let's try and understand two things which are mentioned in the question. There is nominal coupon rate and effective interest rate. While the coupon interest is the periodic interest payment made to investor calculated on a nominal value of investment, the effective interest is the rate of return expected by the investor on his investment, which is calculated as compound interest or an internal rate of return. For the calculation of the effective interest rate, an entity estimates the expected cash flow considering any costs involved in the investment of the financial instrument, such as fees or transaction costs, premium or discount. So one thing which must be very clear to you is that annual coupon interest will be always calculated on the face value or the nominal values of the bonds. On the other hand, the effective interest is calculated on the total purchase cost, which may include the transaction costs, interest rate, discounts, premium, and so on. So how do we account in the investing company, that is in the books of company A? Initially, the bond will be recognized at the cost, that is the purchase price, nominal value of 1 million plus transaction cost of 5,000. So total amount of 1,005,000 has been spent, and on the date of purchase that instrument, company A will purchase the following entry, that's financial asset accounted to cash account. So they have paid 1,005,000 on purchase of bonds. At the end of first year, it is due for company A to receive the annual coupon interest, and they make the following calculation. The cost that they have paid is 1,005,000 and effective rate of 10%. They calculate on 10% on the total cost. And remember, the coupon interest is calculated on the nominal value of the face value. So 8% on 1 million gives us 80,000. And carrying amount, how do we get this? Cost plus effective interest minus 80,000, that is annual coupon. So company A records in their book says, at the end of the year, the interest due is financial asset accounted to interest on financial asset 100,500, and of that 80,000 will be received by the company as the annual coupon interest cash accounted to financial asset account. That's 80,000. Similarly, in the second year, the company E is going to receive the annual coupon interest of 80,000. But the difference here is the effective interest will be calculated on the carrying amount of the previous year. That's 10% on the carrying amount previous year is 1,025,500, and they record as they pass the same entry as the first year, financial asset accounted to interest, but of that 80,000 will be received by the company A. At the end of third year, remember, the bond gets mature. Therefore, the company A is not only going to get the annual coupon interest, but also the balance of effective interest and initial investment on bonds. Similar calculations, effective interest of 10% on the carrying amount of 2021, and annual coupon interest of 8% on the nominal value, that is on 1 million. As usual entry, the effective interest of 10% due is financial asset to interest on financial asset of 104,805. The receiving of annual coupon to 80,000 cash accounted financial asset, and finally cash accounted to financial asset to receive the initial investment and the balance of effective interest which were accumulated from first year to third year. How do we get balance of effective interest? That is total of effective interest for the last 3 years, that is 307,855 minus total of annual coupon interest which we receive annually 240,000 gives us 67,855. So that's how the company A is going to get benefit by investing in the bonds of company B. So that's all from my side. Hope you have understood how accounting records are maintained by the company for investment of bonds in other companies and the computation of interest on bond invested. Thank you and see you next time.